Hey, everybody. Good evening. We're going to get started here in just a couple minutes. Just going to give everybody the chance to hop on in. Been a little bit since we've done a lecture on Zoom. I was out last week, and now I'm back again on Zoom instead of Stages. I was kind of liking the Stages, though. It was a nice change for a little bit. What do you guys think about the Stages lectures? Is it annoying? I know some people didn't like the fact that they weren't recorded, which I can see why that can be frustrating. Hey, Aaron, good to see you. Been a little bit. I'm doing well, Rudy. Thanks for asking. Thank you for asking. We're going to get this show on the road in just a second here. Hopefully, it won't keep you guys waiting for too much longer. Probably send out one more message now. Oops. All right. Well, we'll get started. It's a couple minutes after the hour, and then as more people trickle, I was also thinking about maybe doing like a cross stream onto the stages because I know some people like that. I could maybe try and see. Maybe. No, that's probably going to be too hard. Yeah, maybe I'll think about that. Anyway, welcome in everybody. Welcome to the lecture for the evening. Thanks everybody for coming out tonight. Topic of the lecture tonight is going to be EMAs, but kind of how I've been doing recently. I'd like to start off with just a quick kind of recap of where the market's at. It's been a real hot topic recently, at least for us in the lectures. And I think at this point, we've kind of weathered the storm and are at a spot where things are a bit more stable now. So just wanted to kind of cover some of the reasons why things are the way they are. First and foremost, today we had the Consumer Price Index report covering the month of April. And for those of you that remember, though Trump's tariffs were announced back at the beginning of April, all the way back here, so 4/3. So basically, this last month of inflation, the Consumer Price Index came out for April, showing that inflation actually was below estimates. It slightly increased over the prior number, but again, pretty trivial increase and reasonably in line with what should be normally expected. So that was a really big kind of piece contributing to the move higher today. Again, it's kind of a lot of what we've talked about in the past, right? We talked about this kind of concept in the original lecture months ago on when we first kind of introduced bear markets and kind of how they end and how they start and that sort of thing. And the main things that we talked about were bear markets don't end until the fundamental reason they began changes, right? And again, as a reminder, fundamentally, this bear market began when there was concerns related to how the economy would perform as a result of tariffs, right? Tariffs in the past have been seen to heavily slow economic activity and really put a hamper on the overall engine that is the United States. And with that, there was a lot of investors who decided it was time to sell some of their assets. Back in really early April now, we saw those tariffs pause for 90 days, which was the first step in the right direction, right? The investment community and market participants as a whole are looking to see those tariffs pause as kind of that green light, or at least tariffs, some kind of move in the right direction on tariffs to get that first green light to start buying. And then today or yesterday, we saw a deal over the weekend be announced with China, which was obviously the most significant tariffs that remained. And before that time, there was some more kind of reasonable places to start considering, hey, maybe we're starting to get out of the woods, which is kind of why I wanted to cover this topic on EMAs today. So overall, I think it's pretty safe to say that at least the overall tariff concern is behind us for now. Now, that's not to say that more tariffs aren't announced and we go back to kind of a similar state that the market was in just a few months ago or just a few weeks ago now. But at least as far as the tariffs that currently are aware or exist, it seems like we are basically out of the woods. So with that, it's time to do a little bit of reflecting and see kind of some of the more, I'll say, higher quality opportunities to get involved in the market in the future, because obviously now I think it's safe to say we're in the territory where the uptrend has effectively resumed. Now we're not at new all-time highs yet, and I find it a low likelihood that we just go straight to all-time highs. But I do feel comfortable in saying that at this point, we're out of this kind of downtrend that we had previously faced. And it's time to start looking to the future. We're confidently back above the 200 moving average, which is typically a real important threshold, way above the 50 simple and way above the EMAs as well. Weekly time frame looking very similar, where we're back above that 50 simple on the weekly, and we're also back above the EMAs on the weekly as well, which are a bit less significant but still important. And also a big deal is we're leaving this massive gap behind us on the weekly, which is something that we haven't seen really since COVID, leaving massive gaps like this on the weekly. I can't see a single time. I mean, even in COVID, we filled those gaps. So we really haven't gapped up this significantly on the weekly. I mean, I can't see a significant one in the last 5 years, not even the last 10 years, really. So this is a huge change of character for the market. And I guess there's a nice gap up right there. It's just a little bit harder to tell. But fundamentally, right, the overall character of the market has completely done a 180-degree turn from the way it was just a few months ago. And obviously, we're also, 100 points higher than where we were a few months ago. So it's not to say that this is the most optimal buying opportunity in the entire world. However, as traders, right, it's our responsibility to follow and understand the overall trend of the market. And at this point forward, the trend of the market is, by all definitions, up, and it'll be fully locked in once we hit new all-time highs, which could come in a couple weeks, couple months, or maybe a couple years. But fundamentally, the short-term downtrend and even bear market that we hit on the Qs, in my opinion, is definitely over. So with that said, how can we kind of, what are my reasons for saying that? First things first, the one thing that we've used to kind of characterize this downtrend in our last few lectures has been these 10 and 20 EMAs. And I'm going to just start by sharing this study because everybody always asks for it. So I'm just going to get that out of the way now and share the study. So let me put this in the chat. If you guys want to use a similar EMA cloud, what you do is you go into setup, open shared item, and then you paste that link and you'll be able to import these EMAs basically. So kind of like we talked about, again, I'm rehashing some topics that we've covered, weeks and weeks of lectures ago and recently as well, which is the fact that when the EMAs are trending with the 10 EMA, which is kind of creates this red cloud below the 20 EMA, which is this shorter period EMA, we're in a short-term downtrend. And looking over the past few years on the S&P, right? In general, it was much more difficult to be long when those EMAs were trending to the downside, right? And you can see that time and time again, right here when the EMAs are kind of showing this red cloud, indicating that the 10 EMA is below the 20. Generally speaking, we're in a short-term downtrend or short-term pullback, right? Every single time. And some of the most advantageous places to get involved in that next trend higher is once we see those EMAs flip positive. Raphael, this is an interesting question. 10 and 20 versus 9 and 21, is it just a matter of preference? Yeah, I mean, I would say that for me, the reason that I switched to the 10 and 20 is because can you guys hear me now? Cool. Sorry about that. I have no idea what happened. Not sure how that happened. Oh, it looks like, okay, hang on. Let me just do something a little different. All right. Hopefully the quality didn't get too much worse, but I just kind of switched my input source and hopefully that helps just a little bit. Is that hopefully, yeah, just let me know in the chat. Thanks for doing that, guys. I appreciate that. Sorry again. Okay, I got really distracted. Okay, so yeah, what I was saying was basically, yeah, so 9 and 21 and 10 versus 20, no fundamental difference in my opinion. You know, it's really very close. The one thing that I want to show real quick is this graphic that I used to have on my desktop. Yeah, so this is the book that Oliver Kell wrote. This is one of the most kind of graphics. I've probably shown this graphic 10 to 20 times at this point in time. He was the United States investing champion back in 2021, I think. And he kind of wrote a book on the strategy that he used to win that year. And it was all about using the 10 and 20 EMAs to basically develop his or to find setups to trade basically. So that's kind of why I switched to 10 and 20. I used to use 9 and 21, but for me, it's I doubt there's too big of a difference. Okay. So yeah, kind of like I was saying, over the past really few years, in general, every single environment that's been more favorable to longs has been when we're trading above a rising set of 10 and 20 EMAs. And I mean, I could even remove all other indicators to make this expressly clear if we just take everything else off real quick. You can generally see that periods when we're sitting above the EMAs, it's a lot more easy to buy dips and stay long. Periods when we're trading below the EMAs or the EMAs are trending down, it's a lot more difficult to buy dips, right, and stay long. And then you can see this time and time again, right? Literally throughout all these periods when the EMAs are trending higher, every dip is viable, right? And all periods when the EMAs are trending to the downside, yeah, sure, maybe some dips are viable, but they don't necessarily work too long. So what I wanted to highlight again is that exact same setup basically was gifted to us on a silver platter just 2 weeks ago on April 30th. At least I think that was 2 weeks ago. Yeah, 2 weeks ago, almost last Wednesday or 2 Wednesdays ago. So what do we have here, right? And again, the one thing that I want to highlight in this disclaimer I always like to give before I start reviewing these sorts of things is that anybody can go on any chart and say, look where you could have got long, look where you should have sold, blah, 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 right? And I'm going to do that right now. With that said, the reason that we do that is because we're studying examples that have happened in the past, right? Because these sorts of setups
clearly have happened multiple times before and will continue to happen over and over and over again, right? A very similar setup that we had recently was right around here, right? And not quite the exact same, but we got a nice confident move back above a prior pivot. EMA slipped positive. We left a couple gaps behind here, and we continued higher, right? Something similar probably happened back at this time where we gapped above the EMAs, set another gap higher, EMAs flipped positive, and then we continued higher for months after that. And again, probably something similar happened here, gap above the EMAs, gap again, and we continued months higher after that. So that's three signals that look very similar. Again, not the exact same to the current environment, but very similar. That should show you the fact that this happens all the time, right? And you can see a little bit different this time around, right? We got a gap kind of into the EMAs, kind of sold back into them. Then we got another kind of nice consolidation above the EMAs. And then once we got that nice hold of the EMAs on this day here, another gap higher and another gap higher, but that one filled. And then obviously now at this point, after yesterday's gap, there should be really no denying the fact that we're confidently holding above the EMAs. The trend is very clearly up at this point. So what are some of kind of the setups to be watching out for here? And actually, let me take a pause. I've kind of just been going for it for the last 15 minutes. Let me take a quick break and look at some of the questions. So somebody asked, why are some of the volume bars yellow? Yeah, that's an interesting question, Robs. So that's a script that I wrote myself, so it's not necessarily super scientifically backed, but basically it just highlights above average volume. So when volume is 3 standard deviations above the average, it just highlights the bars yellow. That's all it does. So it just helps to highlight high volume. That's why the script is just called high volume. That's all it does. So it just makes it really easy for me to see when volume is high. So like, for example, on this day, it's very clear that this is incredibly notable volume, right? We're breaking below the EMAs on elevated volume with the bear bar closing near its low. And obviously similarly here, I don't think you need a script to tell you that this is above average, but it is. And same thing with this gap, right? It just helps kind of remove some of the subtle differences and make it real clear to me what's above average with a lot of significance. Does that make sense? I don't think I'm colorblind, 7, but I don't know. Sometimes I can't figure that out. Cool. All right. Yeah. So again, I bring this image up all the time because I think it's something that can absolutely be ingrained to your mind for the rest of your trading career. And the reason I think this is because number one, a lot of the traders in this group are using EMAs to trade. River uses EMAs for a whole lot of his trades. Flips is using EMAs for a whole lot of his trades. Those are two of, I'm sure many of you have taken at least one of each of their trades. So with that in mind, in my opinion, I think it's important to provide a little bit more structure and a little bit more reasoning as to why they work the way they do. So this was kind of a high-level introduction to the lecture in general. I wanted to take a step back and kind of walk you guys to what the EMAs actually represent and then build from there. But with that, any questions or comments before we continue more? Everybody feeling okay so far?
I have a question on the EMAs. It says that there's like certain ticks to it.
I can
Do you
hear.
use like
Sorry, give me 1 second, Dennis.
no
Can you
problem?
say that one more time? My volume was turned down.
So with the EMAs, there's like certain ticks. Like, do you keep it on certain ticks on the EMAs and the MAs?
Certain ticks?
Like, you know how there's a 5, there's a 9,
Oh yeah.
20.
Yeah, that's an excellent question. So I've never heard them called ticks. I've heard the numbers that you're referring to. I've heard that called periods much more than ticks. Not to
Okay.
say that you're wrong, but the answer is I use the 10 and 20 EMAs most often.
Alrighty. Thank you, man.
Yeah, my pleasure. And that's probably a good place to start is clarifying what that actually means, what that represents, because a lot of times you hear, 10 and 20 EMA, and they matter, but you don't really know what exactly that represents. So let's just kind of talk about that calculation really quick. I want to start a little bit simpler and just open up the simple moving average script on Thinkorswim. And this is actually going to be a little bit more confusing than I thought it was going to. Anyway, I'll just say it out loud myself. So, for starters, a simple moving average basically represents the most simple average that you could possibly take. And I hate to use the name of the moving average and the definition of it, but it really is very basic. So, let's just pull a 50, or let's do something easy. Let's pull a 3 simple moving average, 3 period. So, this 3 period simple moving average is currently plotted at 578.06. What I can do is take the close price of the last 3 days. So this day is 564.34. Oops. 564.34 plus the close price of this day, which is 582.99, plus the close price of today, which is 586.84, and then divide that all by 3, which gives us 578.05666, which rounds up to 578.06. So all the simple moving average is doing is it's adding up the last X amount of closing prices. And the parameters that you can do to set that are all included in the study. And this is Thinkorswim. So that's how you would change. It's going to look different on different platforms. But that length is basically the amount of previous candles to factor in. So if I just do the one simple moving average, it should just directly follow the closing price, right? So you can see the moving average just directly tracks the closing price because all it's doing is averaging the closing price divided by 1, which is just the closing price. If I do the 2, you'll see it'll get a little bit smoother between, the last couple closing prices, but still it's basically very closely tracking the candles. And then as I extend the length of that moving average, it starts to have a little bit more distance between larger moves, right? So you can see the 5 simple moving average is now factoring the last 5 candle closes. And then again, the way these moving averages can also be tuned is there's a lot of different things that you could change here. You could have the moving average calculated based on the open plus the high price plus the low price plus the close price divided by 4, which basically gives you the average price over any given day divided by the average price over X amount of days. So hopefully that made a little bit of sense. But in general, a lot of the ways that I set up my moving averages are just based on the close price. It keeps things simple. And typically speaking, the close price is the most important price in any kind of market anyway. You want to be paying attention to price action closes rather than price action opens. Like for example, at one point, it was looking like this bar was going to close down at 576, but ended up closing at the high of day all the way up at 583, which basically shows that bulls are much stronger than bears at this point in time. Did that first kind of rundown of how the simple moving average works make sense? Does everybody get that? Cool. It is pretty simple, but I just want to make sure I don't lose anybody on that. Okay, so the exponential moving average, because that was just a simple moving average, but the exponential moving average basically is the same idea, except for the fact that the exponential moving average gives a little bit more weight to recent price action. So, for example, let's just pull up the 20 EMA and compare that to the 20 simple moving average. So let's do that. Simple moving average and exponential moving average. Oops. So let's do the moving average exponential 20, and we'll make that be dots. And we'll do the simple moving average 20, and we'll make that be a line, but we'll make it a red line and compare the two. So remember that our exponential moving average is the blue dots, and you can see how generally it follows price just a little bit more closely. So it's giving a little bit more weight to recent price action and a little bit less weight to older price action. And whoever invented this, I can't tell you why they thought that'd be a good idea. To be honest with you, I can't explain the theory behind who thought the exponential moving average was, the way to go. However, I can explain to you how it works, which is in general, it's just giving a little bit more weight to recent price action. And you can see how in general, the EMA is basically always closer to the current price than the SMA. And there's times where it's not, like right here, the SMA is closer than the EMAs, but in general, the EMAs track much closer to the current price than the SMA, which just helps, in my opinion, it helps for tracking short-term changes in trend, because it's going to be a little bit more reactive to recent changes, which are ultimately going to be of most concern to us, right? We want to have as least of a lagging indicator that we could possibly have, and those exponential moving averages are just going to be a bit more reactive for us. Yeah, Raphael, that's a great question. Yeah. So is this weight towards recent prices the reason that we don't see 50 or 200 exponential moving averages used for most traders? In my opinion, the answer is yes, Raphael. And I will say I do see people use the 50 EMA and 200 EMA. It's not like the most uncommon thing ever, and I would assume they have a reason for it. But yeah, in my opinion, and I think this is generally accepted, EMA should typically be used for shorter term price action, right? So they're more useful on shorter term charts. Like for example, a 20 EMA, in my opinion, will be more useful for you on a 5-minute chart than the 20 SMA. Does that make sense, Raphael? But I think you're 100% on target there with that question. Rob's, yeah, agreed. The hourly 20 EMA is super, super powerful, and we'll definitely talk about that today as well. Cool. Okay, so that's the difference between EMAs and SMAs. Now, expanding the concept a little bit further, as I've kind of alluded to already, the EMAs can be used in kind of a pair. And the way this pair works, at least the one or this study works, is it combines two separate EMAs. So it's right now using the 10 and 20 EMAs. If I slowed the slow EMA down to 200, you would see very clearly the difference, right? So now you can tell this EMA is clearly the slow EMA, right? It's tracking price much slower. Oh, this is actually not a bad study, honestly. This could kind of work. Look at that. Not bad. Anyway, you can see that the obviously this is going to be the 200 EMA and this is going to be the 10 EMA, right? It's much more closely following price. So hopefully that helps kind of exacerbate the example a little bit better. So when the short-term EMA is trading above the long-term EMA in this study, it paints this green cloud. So here we can see the 10 EMA, which is closely following price, is far above the long-term EMA, which is a 200 EMA, which gives us this nice green cloud. Then once that 10 EMA dips below the 200, we get this red cloud, basically indicating the fact that price is no longer in that same trend as before. So going back to how I previously had this set up to make things a little bit more clear. So here you can see what this looks like on my study, and hopefully now that we've broken down each component, it makes a little bit more sense. So when we see the green cloud, we know the trend is up, right? The 10 EMA is above the 20 EMA. And when we see that red cloud, we know the short-term trend is down, right? Because we have that short-term EMA below the long-term EMA. With that, does anybody have any questions so far? What time frame is best? You mean like time frame for like the candle charts or time frame for the EMAs? Okay, so the the answer, I don't have a real answer to the question, just to preface. If you put a gun to my head and said you could only use one time frame for the rest of your life, I would use a daily, hands down. But each time frame serves different purposes, right? Your higher time frames are always going to give you information on the higher time frame trend, right? So, for example, looking at the daily and weekly gives you these long-term levels to pay attention to, and it gives you the high-level trend, which are two very important things to take into consideration. And it's where every single one of my trade ideas begin, right? And if we zoom out a little bit, you can see that in general, a lot of the levels that I pull come directly from these higher time frames. Now, with that kind of nuance out of the way, in general, I'll also zoom in on the lower time frames to help refine my entry a little bit. So I'll be watching on the hourly for moves close to levels where I'm looking to enter, right? Because it gives me a little bit more insight into what's going on at that level, right? Are we seeing that aggressive buying that I'm looking for there? This is also an interesting level. 2 different dark pools hitting here, 564.43. That's probably a level to watch out for. Anyway, that is basically what I'll do with the lower time frames is use those to actually take my entry. But a lot of my trade ideas are developed on the higher time frames. They don't start on the 5 or 10 minute. They start on the daily or weekly, and they're kind of executed on the lower time frames. So just to summarize, time frame that's best, or if you gave me one time frame for the rest of my life, it'd be the daily. But I don't necessarily think that's applicable to everybody. Like, for example, some scalpers couldn't care more about what's going on in the daily, right? They're counter trend traders on the 1 minute. So, for example, if they see an uptrend on the 1 minute, they're going to short it. If they see a downtrend on the 1 minute, they're going to long it. It just it totally depends on the type of trader you are, kind of like Rob mentioned. But I think in general, at least everybody in this group should be at least having some eyes on the daily. It's a great question, though. Any other questions that I can cover before we continue forward? Anything? You thought the audio cut out. Yeah, Matt's like, all right, hurry this up. All right, I want to give everybody the time. I know sometimes I talk a little bit too quickly, so I try to at least give some breaks for things to slow down. Cool. This is a good question. Do I prefer using EMAs or moving averages? So I actually prefer using a combination of both, which you can kind of see here. So I think each type of moving average serves its own purpose. So for example, on this chart, I have the 10 and 20 EMAs with the cloud. I have the 200 simple moving average in gray, and then the 50 simple moving average in white. So they all serve their own purpose for me. The 250 moving averages are more useful for the longer term trend. And they act as like a key level for me to watch out for. Like, for example, those 50 and 200 moving averages are typically going to be pretty important levels of support and resistance. And when we see a massive gap up above those levels, it's a big deal. Like this big gap up over the 200 moving average, big deal, right? Especially when we're gapping up also above this prior swing high, right? That's not something to look away from. Anyway, yeah, that's the combination I prefer. I like to use the 10 EMA, the 20 EMA, and 50 and 200 simple moving averages. And yeah, Aaron, I completely agree with you. The last 2 daily candles look incredibly solid. While I wouldn't say, this is the place to get long, I think, it continues to be an environment that's going to favor people who are buying on dips at this point. The EMAs are trending higher, and we have to work with that bias until proven otherwise. So as a result, it's you got to continue to look long. BB, have I ever tried to use custom EMAs catered to a specific stock, like odd EMAs, the 6, the 11, and the 17? Um, no, nothing really like that. I've tried different sets of EMAs, and I've seen different sets of EMAs used. Like Tilio, for example, he'll use the 5 and the 13 sometimes on the daily, and he'll trade the crosses in that, which that can be pretty lucrative. So I've seen that used before. It's like a more reactive pair of the 10 and 20 or the 9 and 21. So I've seen that used before. Yeah, this is like an ultra reactive set of EMAs to the short term trend, as you can kind of see, much smaller gap between the two of them. But when these EMAs are trending positive, definitely got to stay long, and they're going to react even a little bit quicker than your what's it called, 10 and 20. So I've seen these used, and I don't hate the use of these at all. But yeah. Yeah, Rob, that makes sense. 18 because it's double the day of the 9. Yeah, so you're using the 9 and the 18 instead of the 10 and 20. Just a little bit more reactive than the 10 and the 20. Yeah, I don't hate that at all. And I think those systems all generally work. The reason that I like to stick with the 21 or 10 and 20 is just because what I have evidence that works and what I've back tested myself. But that doesn't necessarily mean that that's the only way to go about it. So I think the more important thing is to understand kind of the concepts behind the system, and use it how you think is best implemented and whatever works best for you. Okay, so moving on. So we mentioned a little bit about kind of the strength and kind of the I'll say the power of the EMAs. I want to spend a little bit of time talking about some weaknesses as well, because I think it's important to show both sides of the coin and also reinforce the fact that no system in trading is perfect, right? Nothing is ever going to work 100% of the time, and nothing is ever 100% accurate either. So, for example, clearly you can see one of the problems with the EMAs. If you're only getting long when these EMAs flip positive, you would have missed out literally 15% of gains. And obviously that's assuming you would have hit the dead bottom at 480, which I don't think that's super realistic, but you would have missed out on a whole lot of money if you decided, you weren't even going to stay involved. And I think in this case, it was a pretty good decision to kind of stay back and wait for a little bit more clarity. But regardless, that's a drawback, right? You gotta, I'm not gonna act like it's a positive. And then also sometimes you can see, and let me see if I can find one. There's sometimes these kind of like fake crosses that actually don't lead to further downtrends. And that is definitely not an uncommon thing. It definitely happens. I'm just trying to find one recently on the S&P, and I'm having a little bit of trouble, to be honest. So it seems, okay, yeah, this is a pretty good one. So we have this like nice bounce up over the EMAs. EMAs flipped green, right? So here you're probably like, all right, it's time to get long. The EMAs are trending positively. Let's slap it long. And then literally just a few days later, prices 10% lower. So that is going to be obviously a problem. So there are certainly scenarios where you're going to get faked out by the EMAs. But I do truly believe that the 10 and 20 are kind of a sweet spot to the point where they don't have as many fake signals. Like usually those signals do matter. Cool. All right. Yeah. So with that, those are some of the drawbacks of kind of these EMA systems, and with any system that you're using to trade in the market, there's always going to be weaknesses. There's always going to be drawbacks. There's always going to be flaws, right? There's nothing at all in trading that works 100% of the time. There never has been, and there never will be. So if you feel like EMAs are going to be the end all be all, and that's going to be what makes you your millions, well, that might be true. It's not necessarily going to be easy, and it's not necessarily going to be. 100% consistent. And I like what Rob says, 60% of the time they work every time, which is probably true. And we have over the last 3 years on the S&P, they've had a great run. I mean, the EMAs have been incredibly reliable. There's been a few times where they didn't quite signal a long-term trend change. Like here, that's a bit of a miss, right? EMA split positive. If you got long when the EMA split positive here, you would have got blown out, right? It would have been a bad time for you. So I think there's a little bit more nuance to trading the EMAs than just simply getting long when they flip positive and getting short when they flip negative. And I want to use kind of the rest of the session to talk about that. Last thing that I want to note is we have literally been talking about the same instrument the entire time. All of the examples I've found are on the S&P, and there's been 5 to 10 examples that we've already talked about so far. This sort of pattern plays out literally all the time. Like there's thousands of tradable stocks in the market and 100 to 500 stocks that are the most popular with the most volume and typically regarded as the safest to trade. These sorts of things happen all the time on all time frames every single day. So never think that, whatever setup that you're looking at is going to be the last time something happens. Something will always go in your favor again. So don't feel like you need to bet the farm the next time you see the EMAs crossover. Cool.
All right. Cool. So let's talk a little bit about this most recent kind of switch and trend because I do think it is pretty significant and important to pay attention to. Setups come and go. Don't be. Wow, Robs, you got some really good advice today. I like that. I appreciate your perspective, Robs. That's awesome. Yep, absolutely. And even if you miss this trade, right, it's no big deal at all. One thing to remind yourself too is that typically it's not advisable to be long when the market is below the 200 simple moving average. There's been twice in the last 3 years that the market has been 20-30% below the 200 simple moving average, kind of like we were this time around. It's not like you missed anything, right? There's still so much more upside in the market all the time. Maybe you didn't catch the dead bottom, maybe you didn't catch the higher low. I'll tell you right now, I can guarantee you I didn't catch the dead bottom and I wasn't even close. And it's not reasonable to try and do that, right? As traders, it's our responsibility to catch the bulk of the move at high risk, high quality opportunities. And it's our job to minimize the risk of the positions that we take. And getting long when the market is looking like this is really hard to do, especially with size. That's why you kind of dip your toes in, maybe catch some of the bottom, maybe catch some up here. Anyway, so let's talk about this setup because this has been a pretty interesting one. So this is going to be a bit more advanced. So I'll try and slow down a bit and feel free to stop and ask me any questions as you guys see them. And also, you guys are all free to unmute your mic at any time. Just interrupt me, tell me to shut up, and we'll talk about whatever question you have. So as you guys know, I am a big fan of significant levels that are based on either events or kind of psychological spots, and not your typical psychological spots that are 600 and 610 and 620 and that sort of thing, but psychological spots like the 10% correction level, which is 10% from all-time highs, or the 20% bear market level, which is 20% from all-time highs. Two of my favorite levels to watch out for in downtrends. Additionally, I love to look out for levels that have some significance that were developed on a day where we got some news. Today, or excuse me, this day, 4/9, was the day that we saw tariffs paused. So world tariffs were paused for 90 days on this day. And if we just draw a horizontal level from the close of this day, oops, just shift it up just a little bit to be exact. Is anybody really surprised on how price reacted to this level? This is really the only spot you needed to be paying attention to, right? Because think about how the market reacted on this day. This was a huge emotional and short covering reaction to some relief in the tariff area, right? We saw that first light at the end of the tunnel, the first time the market saw, hey, maybe there's going to be an end. And this specific price, 548.62 is the exact price, is where the market decided it should close and they're going to be done buying for the day, right? They could have stopped buying at 540, 530, or 570, right? But this specific price mattered to market participants on this day. Another thing that you have to realize is this is also a day where we're putting in historical volume, right? 241 million shares. Let's just do the math really quick. 240 million times, let's just say an average price of 520. That is 124, wait a minute, yeah, $124 billion worth of money exchanging hands in 6.5 hours or 7 hours in one day. $124 billion, $125 billion exchanged hands on this one instrument. And you could only imagine the amount of money that changed hands throughout the entire market on this day. This is really the significance of volume, right? This is why it matters so much, is because this is real money flowing in and out of the market and into different people's hands and into different people's pockets. And as you guys know, when you put your money where your mouth is, that's when you really care about something. So anyway, a little bit of an aside. Long story short, this close level matters for a whole lot of reasons, right? And we just outlined a decent amount of them. And also, it is just a pretty key price action pivot and also really close to a prior pivot as well, right around that 549 area. And additionally, this same zone is also coincidentally very close to being 10% off the highs. So if we mark a level, this I basically multiplied all-time highs, 613.23 by 90%, so 10% off the highs, which gives us a level of 551.91. So let's mark that out as well.
So we have a cluster of incredibly key levels right here. And again, this is something that this isn't the first time that we talked about it. Like, I know I'm going back and reviewing this example in hindsight, but these are levels that we knew about. I mean, this is levels that I've had on my chart for weeks now, and I didn't have the exact level of the Liberation Day high or whatever the hell this is called, but I have that 10% correction level, and I didn't have the exact pivot right here, but I've had this zone drawn out. Go look at the last lecture; it's all recorded. This is not something that you can only do in hindsight, right? It's been clear for a while that this is the most important zone to be paying attention to, right? There's so many reasons to care about this small area right here, right? Again, we have 10% correction level. We have this prior swing low here. We have the whatever the hell this day was called, 4-9 highs, which was the second biggest green day in the entire market, right? Or in the entire history of the market. This was the biggest one-day gain or second biggest one-day gain ever in history. So with that, I think we've established well enough that this level matters, right? Additionally, on this day, we got the EMAs flip positive, or at least the day before, EMAs flip positive. Then the following day, we retested the EMAs. Yeah, this is the liberation day of the liberation day. Yeah, that's a really funny way to put it. So anyway, on this day, we got the EMAs turn positive, right? That's our first sign that says, hey, we should probably either be cautious on shorts or start looking long. And again, in any market, you probably shouldn't be buying breakouts, right? Just to be clear, any market, if you're buying breakouts that's in a downtrend, there's a lot of risk to that, right? And I've been saying the same thing over and over. It's not a market to buy breakouts. And it still really isn't, in my opinion. Still should be a little cautious on the breakouts. But like, for example, this is a breakout right here. It doesn't look great, but we broke out above the 200 moving average and the EMAs. If you bought that, you got wrecked. So I would have had a similar perspective trading breakouts here, right? Again, still gotta have that same caution. So if you bought the breakout here, obviously it would have worked in hindsight, but it would have been something that I would have wanted to be a bit more cautious for and wait for a bit of a significant retest. Now, I'm not going to say that, yeah, I would have bought right here, right at the bottom. No, I absolutely wouldn't have done that. But after seeing that retest and seeing this day close basically at its highs and reclaiming this level on elevated volume, that's another nice thing, right? So we have two things working in our favor right now. We have a massive price action close above this incredibly important zone. We have the EMA split positive. And again, we also have that nice retest, which is generally speaking going to be that first phase of any breakout or any trend higher. I want to take a quick pause and take a look at these questions. Is that red candle near the EMA cross the example of the test candle from the VPA book before big money moves higher? Yeah, so it's a completely great question, Aaron. This is definitely a good example. I think the actual phrase is like testing the market, right? So this first candle that comes right up to this resistance, this is where we got that first reaction from sellers, right? This is actually a really good point, Aaron. Thank you for calling this out. I may not have mentioned this. So this is that first test of this resistance since this, Liberation Day. And notice that volume on sellers. There's nothing there. I mean, it's incredibly insignificant, right? And this gets us into volume price analysis concepts a little deeper than maybe I was hoping to today. But notice how this is the lowest volume selling basically since the last time we were at this level, right? So very low volume sellers. It's great to see that the amount of sellers there's not many sellers interested here. And then again, right, if you waited, which in my opinion, you should have waited for price action closes above this level, right? I wouldn't have necessarily disagreed with getting long here. If you got long here, I could see that for sure. But I also would have expected you to not cut on this day because you should have been waiting for the price action close on this following day. And seeing a price action close back above this same spot with the retest of the EMAs, also on above average volume, which is again double the volume of the prior day, is huge, right? These are the sort of things that you want to be looking out for because the EMAs can absolutely be a tool to help you identify where these reversals are actually happening, right? Because without the EMAs, it's kind of obvious. Still, something's definitely changing here in the character of the price action, right? We're starting to see we're seeing maybe a little bit of a higher low here. We're seeing decreased sellers, so there's still some things working in our favor. But the EMAs just help solidify the fact that the short-term trend has changed, right? And we're still in the territory of a lower high, right? The market could have reversed right here. This could have been the high, and we would have set a lower high, and it would have been a perfect fake breakout. Regardless, this is a really excellent example of a reversal model, right? It's an excellent example of what to look for when the market trend has shifted. We have a higher low, we have a breakout above really three massive areas of resistance. We have increasing volume as we break above this spot. EMA is slipping positive as well at the same time. I mean, basically, everything was in the Bulls' favor here. And certainly the setup could have failed, and we wouldn't be talking about it today because it would have never happened, and we don't have all the benefits of the hindsight that we do now. But again, this is not some kind of one-off. This is not something that's only happened one time, right? This sort of thing happens very, very often, and sometimes it looks a bit different. Like for example, sometimes it's a breakout of a key trend rather than a horizontal level, right? We've gotten that a few times where we have these kind of key trends to watch out for on these prior pullbacks. Same thing here, right? Not necessarily a key horizontal level that broke, but a couple of these pullbacks were just some trends and a little bit of consolidation moves into the EMAs. With that, we got a couple minutes left. I want to focus on your questions. Does this example make sense to you all in terms of how the EMAs can be used to spot and identify reversals? Everybody's feeling okay? Matthew's feeling ready? Do I mind showing my settings for the EMA cloud? Yeah, absolutely. Yeah, let's take a look at that. So I'll just suggest that you take a screenshot. It should be basically default. But yeah, the fast EMA that I use is the 10. The slow EMA that I use is the 20. Kind of like I mentioned, I will pay attention to price action closes and use that in the EMA calculation as well. And that's basically it. I don't even know what these signals are supposed to do. I guess they're broken. Oh, here we go. Let's see. What do these do? Okay, so it's got some other features too. It calls out. Oh, that's kind of nice. Actually, I actually don't hate that. So it makes it even more obvious where the crosses are. Oh, check this out. Yeah, so look at this. You can see now. Wow, now we can see the fake outs even better, right? Let's actually look at that real quick. This is a good example. I want to really emphasize again. This doesn't work all the time, right? Just like anything. So let's just take a look at these prior examples. So we can see these are all the places where the EMAs flipped. So we got an arrow up. That one seems to have worked nicely. Arrow down. Definitely a bit of a downtrend there, but mostly consolidation. Those all look good. There's a little bit of a fake out. Let's see. Oh yeah, look at that fake out, right? Like on that day, we got the EMAs crossing to the downside and only continued up from there. And same thing here. So we got two really rough signals back to back on these EMAs crossing or crossing to the downside. That's awesome, Robs. Yeah, I'm happy to have you, and you always I appreciate that. Thank you so much for being here. It's awesome. Yeah, I'd love to have you, and that's the right mindset too. So many people, and sometimes myself even too, fall into the mindset of thinking like, oh, I don't need to go to the lecture. I already know it. But as traders, right, you should always be learning, and that applies to things outside of trading too, right? You should never be too comfortable in the knowledge that you have because there's always something else to learn. And who knows, maybe something's going to be said in a little bit of a different way that clicks a little better, or you learn a little bit more about theory. And maybe one day, Robs, you'll teach the EMA's lecture. Maybe next week we'll have you break it down for everybody. It's awesome. Appreciate that, Aaron. John, the question from John is why again do I use both EMA and SMA? So again, the SMAs to me correspond typically to short-term trend and short-term price actions. So the EMAs help me better respond to short-term changes in trend, whereas the SMAs act as kind of longer-term key levels to be paying attention to, and also they help me better understand the long-term trend as well. Does that answer the question for you there, John?
All right, everybody. Well, I think that's going to do it for me tonight. Yeah, I always appreciate all you guys' time. Sorry that I missed last week. While you guys are here, before we call it quits, what's your guys' thought on Zoom versus stages? Do you guys like Zoom more than stages? Do you guys like stages more than Zoom? I've definitely noticed it the past few weeks. I did, and also, how about hours too? Because I did a couple lectures during market hours. And that they were pretty popular. But I don't want to yeah. So the Zoom video quality is better. Okay, you never been on a stages lecture. Okay, so it's kind of like two separate crowds. Yeah, like you got, I totally get it too. Like the Zoom is for sure for the after work people who kind of want to actually focus, and the stages is people who are maybe multitasking or maybe don't work during the day. What link, Scotty? The share link. If so, I'll put that in trade floor. That's the only link I shared, so I'm assuming that's the one. Yeah, I'll just put it in trade floor right now. And I think your Discord name is Scotty Golden too, right? Also, I'll just tag you. There you go. All right, I just put that in trade floor for you. Zoom and during market hours. Okay. So yeah, I mean, it seems like you guys wouldn't be. It seems like the Zooms are still good for everybody, and maybe a little bit different, like a little bit more variety. So some Zooms, some weeks, and some stages, and a little bit of both. I don't know. Anyway, I just want to ask the question. There's no real change coming imminently, but kind of wanted to try a little bit of both. Cool. All right, everybody. Well, thanks so much for your time. Really appreciate it as always. And I will see you guys all in the next one. Audience, everybody. Have a great night. Peace.
Yo, Tostie.
No, Norm.